Welcome back to the Williams Real Estate channel. I'm your host, Geordie Williams, and today we are running through the Williams Real Estate Investment Strategy, 10 properties in 10 years. As you can see, it has been slightly updated based off the current market conditions, based off what we're seeing out there, based off what we're buying, and the most productive and efficient way to get to 10 properties if you are on an income of anywhere between 60 to 100 grand. 10 in 10 years is very achievable using this strategy. And if you're on 200 plus thousand, you easily smash it out of the park within 4 to 5 years. Bit of a backstory, I guess. My property investment journey, I'm up to 17 properties now across 3 states, being New South Wales, Queensland, and Victoria. Consist of units, villas, probably two of them, two units of villas, 10 or so houses, and 2 blocks of units. So I advocate buying units, houses, and blocks of units. I don't just specifically stay to one type of asset, as they all work well in synergy in order to get you to a large sustainable property portfolio. So if you're starting from scratch, we like to start with a unit, typically units in Sydney and Melbourne, or a villa or townhouse style property in Brisbane. Once you're into those markets, you have good growth. You can get them at a relatively affordable price bracket. I mean, these days we're picking up units in Sydney for sub 350, units in Melbourne for less than 300 grand. So you really only need 50 grand to get started. So I say 50 grand, but I mean, you would typically use, I mean, if you're going with a 10% deposit, all the closing costs, approximately 17% you need. So around 45 grand is the actual cost, but obviously it's a good idea not to just have no money left in your account when you get started. So 50 grand minimum. So then you got at least a 5 grand buffer, and we can get it going. And that's all you really need to build a property portfolio, because you'll leverage the growth from one deal to the next. And then as you keep growing and the market moves, you'll keep compounding your wealth. You'll then be able to strip more equity. You'll be able to borrow more than that original 50 grand, and then keep rolling it from one deal to the next. So these days, I typically refinance one property every 6 months and drawing anywhere between 150 to 200 grand. But I was in the same position as everyone when they first start, and you start by getting whatever money you can get together to ultimately get your foot in the door. And then once you're in the market, then the market will do the heavy lifting, and then growth and it just snowballs and carries on. So Sydney, Melbourne is where we're focusing now, also based off the 18-year land cycle. These markets are prime for growth. They have had subdued growth the last few years. So that's where we like to get into a market where there's been subdued growth, because it's only a matter of time where they'll hook into their next growth cycle. We're now no longer focusing on Brisbane and Queensland for now, as they've had significant growth the last few years. And we see that those markets are now becoming more overvalued than undervalued, when we only like to buy property for undervalue, but then also under the intrinsic value of an asset. So we're value investors, and we see the Brisbane, Perth, and Adelaide markets are now overvalued, and we are no longer advising clients to buy in those markets for now. Maybe in 5 to 10 years' time, once the markets have cooled off and they've gone through a protracted period of flat growth again, then we'll be looking at those markets again. But over the next 5 to 10 years, we are focusing on Sydney and Melbourne. So Sydney, Melbourne, get into those markets, then leverage the growth out of them into a couple of regional houses. So this can be either New South Wales, Victoria, and Queensland. We like to stick to the East Coast. And then once you're into a couple of regional houses, then you would level up and go for a duplex. So regional houses we're picking up these days anywhere between 300 to 400,000. We don't like to go too far above that 500 grand mark, because once you get to that 500,000 mark, that's when you're talking dual property income, such as a duplex. So 2 units on a single title. So you've got double the rental income. So duplexes, we pick them up anywhere between 5 to 550. And then once you go above that 5 to 550 mark, that's when we start looking into blocks of 3 and 4 unit blocks. So blocks of threes around that 600 grand mark, blocks of fours, 700 grand mark, 800 grand. And then you can continue to keep going. Once you have got to the stage where you've only got, when you've bought your final block of units, you may want to keep going. So that's what my goal is. I'm going to keep going. Every year now, I'm selling down the singular properties to then reinvest the gains into blocks of threes and blocks of fours and keep scaling up. You may want to keep going. You may then want to go commercial. You may want to just keep your 10 property portfolio and let the rents pay it off. It just provides you a war chest piece of your base foundation portfolio is what we specialize in, building your base. And it's then at that point, you can then decide on which way you wish to go, because it ultimately will give you lots of options. And you may want to start trading properties, so selling the smaller units once they've had double the capital growth, and then rolling them into larger assets and larger deals to keep growing. Or you may want to leverage the portfolio into your dream place, sell down half the portfolio to pay off the debt outright and have an unencumbered portfolio. The options are endless, but ultimately we'll get you to 10 properties within 5 to 10 years, depending on your capital, your income, and how hard you want to push the envelope. You may want to just stick with the big four banks. They typically lend 4 to 5 times your wage. You may want to then start pushing the second and third tier lenders, which can typically lend up to 7 to 8 times your wage or your household income. So if you've got a partner involved as well, you may even want to look at setting up a trust, because when you set up a trust, the properties that are bought within the trust, the banks look at it with a different light. They don't shave the rental income and they don't add the buffer to the interest rate. So they take it on face value. So that's when, I guess, when you start to buy blocks of units, that's a good idea to start buying them in a trust, because then your serviceability can typically be endless. So starting off, I say buy them in your personal name. I mean, this is by no means financial advice, but this is what I've done. Bought in my personal name to max out your land tax thresholds of each state. Once you're hitting those thresholds, then you may as well put it into a trust anyway, because you'll start paying land tax on day one for every property that's in a trust. And it also, trusts give you better, I guess, protection if you've got a business and there's a potential chance of you being sued. Trusts provide that additional layer of protection, and there's also additional benefits of trusts where you can minimize your tax liability, as you can pay out the income to the beneficiaries, such as your family members or your children and so forth. So there's lots of different options of structuring and getting lending that can get you to 10 properties a lot sooner, that we can explore. I can get you on a phone call, get you on live Zoom to run you through this. But ultimately, I can get you to 10 properties in 10 years based off what I've done and my experience. And then once you've done that, this is what it would look like over a 30-year period. So if you bought, I guess, starting from scratch in 2025, and you went hard and got your 10 properties in that 5 to 10-year period, once you've completed that, you'll be sitting on $4 to $5 million worth of assets. You have just over $2 million worth of debt. And then if you held that for 30 years, in 30 years time, you would have over 16, 17 million bucks worth of asset value. And if you didn't pay $1 off, you'd still have your just over 2 million bucks worth of debt. So, I mean, this is a long spreadsheet that I've also developed to help you plan out every year to have a goal to set to keep recycling the capital gains into the next deal. But ultimately, if you started and built the portfolio up over the next 5 to 10 years, you'd be sitting over sitting on well over 17 million bucks worth of assets, 2.4 million worth of debt, and you would have a net worth of over 15 million bucks. So that's if you got your cracking, and that's only using 10 properties over 5, 10 years. So I can help you build that. To dig a little bit deeper under the hood, this is what the current deals look like. So units in Sydney, sub 350, they have a yield of around 6 to 7% and a slight negative cash flow on purchase price of 150 bucks or so a month. The units in Melbourne, slightly cheaper, the 280 to 300 grand mark, better yields, 7 to 8% yields, and they're uh, positive geared on day one. So, I mean, $4 a month, but just pretty much breaking even on day one without even really having to push the rents. Regional houses. Regional houses have had a significant run in the last few years, so the yields aren't as good as historic, but anywhere between 6 to 7% 6% for the regional houses, and around that 350,000 purchase price. And once you then get into, say, blocks of units, so once we get up to around that 500 grand mark, that's why I like to go for duplexes rather than continue to buy up houses, because you can not as well with the cash flow. If you can spend 500-600 grand and get a duplex, you got two rental incomes, better cash flow. Then you've got the upside of strata titling, and you can sell them individually as well, which you can't necessarily do with a house. You have to build a second dwelling. Can be a lot more moving parts, a lot harder to do. It's a lot easier to just strata title an existing unit block. It's a bunch of paperwork. You submit it to the council, engage a third party strata company to manage the property. That ultimately boosts the value, and then you can then refinance that, draw the equity, keep going, or you may want to sell to then trade into a larger asset, another market that is prime for growth. So I really like unit blocks. Ultimately, you want to get into just unit blocks. The biggest developer in Australia, the biggest property investor in Australia, Harry Triguboff, the owner of Meriton, only builds to rent high-rise apartments. He started 60 years ago building blocks of fours, blocks of threes, blocks of fours. Now he's building 1,000 high apartment building with 1,000 units. But he scaled his way all the way up, starting from blocks of threes and fours. So I'm modeling my strategy and the strategy I use to help clients based off Harry Triguboff's strategy, and it's just ultimately you just want to land in blocks of units, because that is the gravy train. That is the best spot to be in from a cash flow perspective, but also capital growth when you go to strata title and sell them off as individual. Because it's like buying a bulk deal. You buy a carton of eggs for $5, and then you can go to the markets and sell them off individually for $1 each. So it's the same concept. You can buy them in bulk for a discount. You can strata title them. You can then sell them or refinance them or sell them. It gives you lots of options. So that's why we don't like to continue to plow into houses, because there's better opportunity and better deals to find in multi-family. So blocks of twos around that 500 grand mark, blocks of threes, 600, blocks of fours, 700 grand, and the sky is really the limit. I mean, you can buy blocks of eights and tens in Sydney for around the 2.5-3 million bucks. So there's good opportunity, good value out there to be had. So the yields on the blocks of units, so blocks of twos, 7+, blocks of threes and fours, around that 8-9% yield. So the blocks of threes and fours, they're positive geared on day one, usually bring in about 500 bucks a month in cash flow, positive cash flow, and that's sitting on a 6.8% interest rate. So once interest rates come back a bit to the 2 to 3, 4%, that is the gravy zone. So even with these high interest rates, we're still finding solid deals, blocks of threes and fours that are positive cash flow. And for me, personal strategy, this is what I'm looking to buy for the next 5-10 years, is just blocks of threes and fours, selling off all the individual to roll the capital gain into the blocks of units. You need to start small, like building a campfire. You start with the kindling being a single unit, then you move on to split wood being a couple of houses, and then you get into blocks of units, which is like putting logs on the fire. You don't want to rush straight into blocks of units because they are slower moving assets. They come with a little bit higher risk. So to say, you own the whole asset, there's a lot more moving parts than having a single house or a single unit. So you have to maintain the complex and so forth, but that ultimately comes with a higher reward with the yield and the upside once you start a title. And you also need a larger deposit to get into them, typically 30, if not 40% deposit. This is why we start off with the units and houses to gain the equity, to then roll that equity into the blocks of units by either refinancing or selling them down after 5 to 7 years once they've had 100% capital growth, to pay down the debt, raise cash, free up serviceability to then roll into larger deals and keep the gravy train moving on. So if you like that, if you want a copy of this spreadsheet that I've developed, send me an email. I'll put my email detail comments below. This is the 10 property in 10-year strategy, most sustainable way, I believe, to get to a solid residential foundation portfolio within a 5 to 10 year window. And then it's up to you of what you wish to do. From then, you may want to keep carrying on and keep building the portfolio out in residential, in blocks of units, or go commercial, or call it quits. Ultimately, I'll get you to 10 properties in 10 years sustainably, safely, for a very achievable time frame. Thanks for watching, and I'll catch you next time.